Rightio, you're right to go, Bryce.
Perfect. As always, thanks for having me along. I enjoy doing these and giving you guys a bit of an update. Hope you've all been keeping well and had a nice break over Christmas and New Year's since I last presented. For those of you that maybe this is your first time joining us, my name is Bryce Leyden. I'm a client sales executive from Vanguard. Firstly, with the presentation, I'll sort of touch on who I represent here at Vanguard and our business, and then the focus of today's update will be our economic and market outlook for 2021. This will touch on the continued market recovery from COVID and what we're seeing through countries and communities as they try to close what we're terming the immunity gap. I'll also look at what impact we're seeing through changes in inflation recently and what challenges and opportunities are presenting themselves in the market going forward. As always, happy to take questions throughout if you do have one, so feel free to sort of unmute yourself and ask away, or if you like, you can put it into the chat and I'm sure Brent will bring it up when he gets a chance. This is just a reminder that everything I talk to today is general in nature and not personal advice. So if you do require personal advice, please speak to Brent or anyone in the team at Kennas and they'd be more than happy to help you with your own personal circumstances. So as I mentioned, the business I'm here representing is Vanguard. We have over 40 years experience in the funds management industry, starting in 1975 out of Malvern in Pennsylvania. We're one of the world's largest global managers, managing over $9 trillion worldwide. And interestingly enough, we've done that through natural growth. So we haven't ever acquired another firm or merged with another firm. That's purely been from investment driven. And that's partly due to our mutual fund structure. So what's unique about that is we're actually partly owned by our investors. So rather than an ordinary company where you might have shareholders that we have to pay dividends to or sort of pay out earnings to, we actually use any profit we have back into the business in developing new products or reducing the fees for our investors. Before I do jump into, I guess, the year ahead, I thought it'd be good to have a quick look at how the end of 2020 played out and what we saw. So market volatility was still ever present during the final quarter of 2020. This was largely driven by the controversial US election in November, the looming Brexit deal deadline in December, and then that continuing China trade tension that we're seeing with the US and also here in Australia. And it's hard to forget that we still have the ongoing global spread of COVID-19 going through Australia and everywhere else. So, but even though despite these and other unsettling factors, investment returns over the December quarter as a whole were actually relatively strong. So at the end of the 2020 year, the US share market actually closed at a record high. And that was largely spurred on by positive sentiment around the economic stimulus that we're expecting to be rolled out by the Democrats, and then also the impending rollout of the COVID-19 vaccine throughout America. The Australian share market, although we're still off our record high that we reached last February before COVID, did close off the final quarter with a large gain of more than 10% above where it started. And a bulk of this gain actually occurred during the November month, where we actually saw the ASX 200 notch up its best return since 1988, so the best return in over 30 years. So I'll get my pointer out here so I can just show you. So as we can see here in the chart, so this was the last quarter return. So as you can see here, very large returns in the Australian market, sort of 13% overall, with still solid returns coming out of the international market. But as you can see, if you look over the entire year, even with that volatility we saw and a recession almost occurring in April, we can still see that most asset classes actually performed quite strongly for the year. And that sort of shows a sentiment of why you sort of invest for the long term and not get too phased by short-term volatility. So besides Australian real estate, which does have its other problems, most of the other asset classes have posted a positive return for the 12 months. As we experienced personally, the COVID-19 pandemic has produced some of the most pronounced economic shocks in multiple generations. In 2020, we saw recessions around the world were quite deep. We saw supply chains being disrupted, and then also policymakers all around the world were quite aggressive in supporting financial markets and their economies, trying to keep them in good position to bounce back afterwards. While the global economy is still recovering as we continue to head into 2021, we're going to continue to see the battle between the virus and humanity's efforts to sort of squash it and see us all return to a normal life. The global recovery currently still stands at a pretty critical stage, with economic factors continuing to take a back seat, and the main concern being around public health policy and the path of the virus. We view the next phase of the economic advance as more challenging than what we saw last year with the bounce back experienced in the third and fourth quarters. But ultimately, it's going to be really a combination of effective vaccines and therapeutic treatments emerging and becoming more widely available this year as we see the rollout of those first round of vaccines that are helping the economy. To that, we believe that the pace of the recovery will be driven by what we've termed the immunity gap. And what that is that's the percentage of the population lacking immunity to the virus. And then also the reluctance gap, so the reluctance of a percentage of the population to engage back in economic activity. And we see that closing that immunity gap will hinge most critically on that combination of the population willing to be vaccinated, and then also that vaccine's effectiveness, which we saw in trials is around about 90%. I think in reality it's come down a little bit, but it is still quite effective. And another key element, which won't be large here in Australia because we have been so good at keeping the virus out, is the degree of immunity that's been acquired by people that have already had the virus. And so what we can see here is how these sort of all play together is as more people become immune, so you start to reduce that and get that herd immunity through communities, is that you'll see more people immune, which means less people are worried about going back into the economy and engaging in activity. So that reluctance gap will start to close as a result. And then what that does is overall leads to a healthier economy and a stronger economy. So as more people are engaging in spending and demand rises, that should reduce the amount of unemployment, which also reducing the output gap. So we're seeing the economy return back to its full potential, whereas at the moment we're seeing it sort of operate at that under potential due to these factors. And along with, I guess, those health policies restricting economic activity, the reluctance gap has had an outsized impact on specific economic sectors, especially those heavily dependent on face-to-face interactions. And that's explaining most of the remaining economic gaps we're seeing in regions where the virus is still circulating quite widely. So what we're showing here on this graph is it shows the pronounced effect on, I guess, the global labour markets, as well as the consumer services sector. So those main ones, sort of your restaurants, entertainment, transport, those all remain in deep stress. As we can see here, they're still 11 to 12% off where they were the year previous. So still seeing a lot of lack of re-employment here just due to the lack of demand. The pace of the next recovery or next phase of the recovery is going to be a function of that immunity and reluctance gap. So the greater immunity and reduced reluctance will drive a sharper recovery. And under our more optimistic scenarios for a vaccine effectiveness, we see that much of the economic losses stemming from the pandemic could actually be recovered within the next year or so. While on the flip side, if we saw a persistently large immunity gap, possibly a result of a less effective vaccine or an elongated distribution cycle, this might leave economies with only marginal progress from our current levels. And then in a central case, or that most common case, we project still a positive recovery path that will extend beyond this year before we sort of get back to maybe those pre-pandemic trends. So what this graph here just shows you sort of visually what that sort of recovery path might look like. So if we didn't see COVID come about, this is sort of the trajectory we were on. It was sort of still quite a slow positive growth, but we can see off this sort of quick bounce back, if we have an upside, we should sort of come in line with that pretty quickly. And that base case still sees us getting there, but maybe probably a year later than what our upside scenario has us having it. And just to maybe make that a little bit easier to view, we do have this sort of table version as well, which might be of interest. So this outlines that the downside base and upside scenarios that we might see over the next 12 months. And with this as well, our economists have also assigned the likelihoods of these occurring. So although the downside would see us sort of not reach pre-COVID levels for quite some time, the odds of that scenario are quite low, and a lot of, I guess, things would need to occur for us to end up in that downside position. Whereas the base case, that most likelihood situation is sort of that 60% chance of occurring, and then the upside sort of with a favourable 30% chance. So touch wood, we continue on that positive trajectory, and the vaccines continue to do what we need them to do, and we can get back to a normal faster. The unevenness of our growth outlook at the moment is largely reflected in the major economies and our outlook for the year ahead, as you can see in this chart where we've shown the potential growth improving in 2021. As I mentioned in some previous updates, that China's been a fairly, or pretty much an outlier in its swift return to near pre-pandemic output, as we saw the sort of the first in, first out scenario with COVID. And we see that extending into 2021 with then sort of a growth prospect of 9%. We're expecting growth in the US and Euro regions of around about 5%, with these economies sort of extending or marginally below their pre-pandemic output levels than we previously saw. In the emerging markets, we expect a fairly uneven and challenged recovery here, although aggregating out to probably a growth of around about 6%. So overall, still a solid growth there, but we expect that to be quite varied between countries in the emerging market space. In 2021, we also anticipate a cyclical bounce in consumer inflation from the current pandemic lows we've seen of sort of near 1%. We're expecting that to sort of rise probably closer to 2% for a time. With that rise, though, there is a bit of a risk that markets could confuse this with a modest reflationary bounce instead with a sustained period of above target inflation. In our opinion, we maintain sort of a long-held assessment, that sustainable inflation rates above 3% or more are just very difficult to generate in developed markets at the moment, making this scenario probably unlikely to pan out over the long term. So we don't really see this occurring. We might see a short-term bounce, but likely they should come back to sort of below that target level. Here we've listed a few areas that we've seen either being accelerated by COVID, potentially will remain only temporarily and should sort of fade after COVID, and that others we've seen have actually been unchanged by the health crisis. So we've seen COVID accelerate trends such as sort of the digitalization of economies. We've actually seen it create a bit of de-globalization where due to sort of those disrupted supply chains, we've seen a greater reliance on internal. So even here in Australia, we had to rely more on localized goods as opposed to globalized. And it's also sort of influenced and pivoted policy frameworks and the role of state. So we've seen that also increase. Some aspects of the global economy that we view as sort of probably being unaltered is the contentious US-China relationship. So we view that that's going to continue trucking along for years to come. And also what we've sort of developed out is this idea multiplier. And what that is the likelihood of increased innovation acting as a boost to productivity in the years ahead. So we saw it with the IT boom sort of in the early 2000s, sort of that exponential growth through that sector. And we're now seeing it through sort of the biotech area and medicine where COVID sort of boosted that. And we're sort of going to continue to see that. And one widely recognized trend that COVID has accelerated, I've touched on it before, is the increased work location flexibility. So given that most businesses were forced to reorganize around remote working, we're going to see that that's going to come under increased scrutiny probably over the next 12 months as businesses start to explore, I guess, the pros and cons of that shift and whether it actually, the benefits sort of outweigh the negatives of not having people in an office. Our analysis found that across developed economies, occupations in which a majority of labour is employed were actually well suited for remote work. And I guess if you look at it, if you work in a manufacturing or a service industry, the ability to work remotely is quite limited. However, if you predominantly work in a desk-related job, working behind a computer, this has gained a lot more flexibility in the new environment we're working in now. The composition of the recovery, barring, I guess, the widespread distribution of the vaccine before the first half of 2021, will continue to be rather uneven. And this is due to the consumption of goods and normalization of heavy industrial production, likely to outperform that still of the services that require, I guess, high face-to-face interaction. We see that the output gap here is not expected to probably close until close in 2021. We see that's going to sort of close probably in the year after, and that growth in unemployment is expected to be subdued and spare capacity likely to persist, especially as policy support measures such as sort of JobKeeper get taken out. So we see that combined with sort of new jobs being created by COVID vaccine allowing us to go back to normal, but those sort of, I guess, support being pulled back will sort of counterbalance each other for a while. We're not going to see that immediately close. And this in turn will keep wages growth and inflation low. So that's where we're sort of saying we don't expect that sustained inflation rate to go above 2 or 3%, just due to those factors which will have sort of a downwards pressure. I guess beyond just fiscal policy and the virus itself, there are other major risks to the outlook, which stem from the growing geopolitical and trade tensions with China. Last year, we did see China impose some restrictions and tariffs on Australian sectors, so the beef, wine and barley industries. And recent media reports suggesting that there's probably more export categories that could be implicated in the future. In this graphic here, we explore the avenues that are most likely to be affected should relationships with China further unravel. And ultimately, the goods and services for which there is greatest substitutability are the most vulnerable to a pullback in Chinese demand. And this specifically is sort of exports of food. Certain raw materials like wood and sulfur appear to be the most at risk should trade tensions intensify. And I guess the way that you can sort of interpret this chart, if you're having a look, is the left to right is sort of the Australia's reliance on China demand. So the further right one of these items is the more that we rely on China for the demand, so the more at risk we are. And then bottom to top is China's reliance on Australia for exports. So the higher it is up on this, the less likely it is for China to impose tariffs or, I guess, try and do anything here. So something like iron ore, which makes up a very large portion of our GDP, is unlikely to be impacted just due to China's reliance on us for that as well. So it's unlikely they're going to go the sort of the mutual destruction route and sort of impact their own GDP, as they have very aggressive growth targets as well. So it's likely that, as we sort of mentioned, they're probably going to focus more on these substitutable items where they have other suppliers they can go to, which would impact us here. From an overall point of view, though, these do make up a very small portion of our GDP. So from an Australia-wide point of view, would have low impact. But obviously, if you're in those industries, it would have an extreme impact if China were to withdraw from them. Longer term, we believe Australia should consider diversifying its export base and look to other markets for opportunities. So history suggests that the concentration of exports into a single country is not unique just for Australia, but we've actually shown that Australia itself has been quite successful in adapting and seeking out new markets over time as we've needed to. So what we've shown here is since sort of the late 1800s, Australia's been quite good at reducing its reliance on its top 5 and top 10 countries. So the purple being top 10 and the blue being top 5. So as you can see, over time, we've managed to sort of drop that from sort of nearly sort of 100% reliance on the top 10 countries to sort of reducing that down towards 70% reliance. So it's still quite high, and that is due to, I guess, our locked-in nature. We have a few local trading partners we can deal with, but I guess as we've grown over time and globalization keeps going, we should be able to reduce that further. When our economists look at what the 10-year outlook might be, what they do is they use a VCMM model that we have, which puts in over 10,000 simulated outcomes and produces a range of returns for different asset classes, given all the variety of inputs, so both positive and negative scenarios. And what we produce here is a range of expected returns. So the blue chart in the middle is our central expectation. So that's sort of the middle 50%, so what our most likely chance is. And then these bars going out to the right is that upside potential, and then the negative, or I guess the pessimistic outcome chance. And then we've got volatility. So within 1 year, how much volatility might we see swinging sort of up or down in a market? And what we've seen this year is valuations are a very important input into our return forecast. And this is largely due to a broadly cheaper market providing tailwinds for return expectations. So from an Australian investor's perspective, the expected return outlook for local equities is in the range of around about 5.5% to 8%. And this is the annualized figure over a 10-year period. And that's actually sort of improved from our previous expectations. And then when we look at global ex-Australia equity outlook, this sits higher than it was last year as well, but slightly below domestic. So that's looking more sort of at that 5 to 7% range over the next decade. Even though despite the marginally higher expectations for local equity, we do as always caution against excessive concentration into home bias. And we see that it's due to the missing out on the benefits of a globally diversified exposure in managing risk. particularly given expectations for elevated risk in the next year or two. So you can see here these sort of high volatility of 20% across markets. Diversification will sort of reduce your risk through that benefit you're receiving. And then on the flip side, we do this as well for our fixed income. So at the moment, with yield curves around the globe fairly compressed and the accommodative monetary policy we're seeing come out of the RBA, our fixed income outlook has been slightly downgraded from last year and does remain quite muted across the board. So in the Australian bond space, we're expecting returns of around about 0.5% to 1.5% over the next decade. This is roughly sort of 0.2% lower than our figure last year. Meanwhile, in the global space, in the global bonds, returns are likely to remain marginally higher than local bonds at around about sort of 1% to 2%. Looking at this though, you might think, oh, I'm getting such low returns. Why would I still hold bonds? And we still view that they're a very key role in a portfolio in your defensive part. So you do need that balance in your portfolio. So as you start to see volatility, these will dampen that and reduce that sort of big swings you see in your portfolio. And I guess to bring these two outlooks together, our economists have used the forecasting models to look at the real return that may be generated from our diversified funds and also the potential for downside risk within those funds. For those of you maybe haven't seen them before, our diversified funds, some of you may also hold these already in your investments, are investment products which are managed by our investment strategy group. So they set the allocation range for defensive and growth assets within those portfolios. The conservative fund, as the name might suggest, is a more defensive product with only 30% in equities and the larger portion being 70% in fixed income. And that ranges through to our high growth profile, which is a more growth oriented fund with 90% in equities and 10% in fixed income. And when we look at this left-hand side here at the probability of achieving real return targets, and what real return refers to is the investment return after inflation. So as we can see here, the more weighted you are towards equities, the greater likelihood of over a 10-year period of receiving a higher real return. So if you were looking for sort of 5% or more over inflation, as you can see here, the higher you are towards equities, the greater chance you have of achieving that. But with that higher allocation though, and higher return potential does come with greater volatility and risk. So if we look at the right-hand side here, which now is the downside risk charted, you can see that the high allocation to equities also results in a greater chance of an individual year volatility. So what this shows here is in any given year over the next 10-year period, what are my odds of having a return of potential return of -10 within a year, -20 or 0? So even with quite a conservative outlook, the odds of having just below a 0 still quite high over a 10-year period. So if we saw a year like we saw last year, you're still not completely protected from large volatile swings. But as we go further up the spectrum, your odds of seeing a drastic movement within your portfolio when you have a much more defensive position does go down. But what that really means is over a longer period of time, if you are wanting a greater return, you need to be prepared to be able to sit through much bigger volatile swings in your portfolio. And that's something you can discuss with your advisor around what kind of outlook you need and what also kind of risk tolerance you have for larger volatile swings within your portfolio. This year, more so than in the past, our outlook for both the economy and financial markets hinges on a number of factors. While health outcomes take preeminence as a near-term driver of outcomes, there are several other considerations for the longer term. We've actually aggregated our perspective on a lot of these drivers here in this table, tying in with our sort of macroeconomic view on what might happen through asset returns and portfolio construction. I won't run through all of these now, but we will be distributing out these slides afterwards. So if you do want to sort of have a quick look at what sort of drivers might be happening through the market and I guess how they sort of play out through various outcomes, feel free to have a look at this afterwards. And if you do have a question, I'm happy for them to be shot through afterwards. Just to summarize, I guess with a lot of this recovery, it will still begin with the health. So COVID's still a driving factor. So closing that immunity gap and returning confidence to the market is going to still be the key driver in economic performance over the next 12 months. When it comes to global inflation, we do expect to see modest reflation, but it's not going to be a return to high inflation in our opinion. And then when we're looking at global asset returns, so again, sort of recent market performance and those lower valuations have moderately raised our portfolio expectations for equities. Just want to check, have we had any questions through the chat, or has anyone got any questions after that?
I haven't had any questions through the chat, Bryce. I've had some computer issues, so I've had to log out and log back in. But yeah, if there's any questions from the floor, you can unmute yourself, or you can put it in the chat box and we can ask Bryce.
What's your opinion on the ASX at the moment, Bryce? Is it's bounced back up to over 7,000 at some point. Is the expectation that it's going to sort of hover there and just mildly increase, or it's just still unknown with the virus and what's going to happen with lockdown?
Yeah, so I mean, touch wood, we can sort of keep the virus contained here and not see more snap lockdowns or anything like that. So we might see that Victorian lockdown might have some impact through it, but from what I've seen from the sort of the reports coming out, I mean, business growth has been relatively good. So, but I think going forward, we're going to see a more stable growth. We're not probably going to see as much of this rapid movement, as long as we can, I guess, we can keep that sort of lockdown at bay, because we're not going to see the vaccines here probably for quite some time compared to the UK and the US, given we've been able to stay in a good spot. So if we can keep that at bay, I think we'll see sort of a modest growth going forward, sort of in line with our forecast, but more of a smooth approach than what we've seen previously.
Yeah, because it's gone up in steep tranches at some points, hasn't it, really? Like, you'll check one day and the next day it's just gone up by a heap, and then it'll sort of flatten out a bit, and then it'll go up again. But that's sort of coming to an end. Is that what you're thinking?
Yeah, and I think with that sort of COVID news that comes out, I think we're probably seeing it more recently. Last year, any sort of news about it was creating volatile swings. And I think we can see the reduction of that going forward if we can keep the virus at a good level. So, I mean, you're even probably seeing it with the US a little bit as well now with the vaccines rolling out. The more, I guess, confident people are that there's not going to be these giant outbreaks again, they're not as susceptible to that virus news. And it's going to be more so probably other news coming to the front. So that sort of China trade tension becoming more of a focal point, and other areas of the economy becoming more, I guess, of interest to markets, as opposed to what the COVID's doing.
I guess you see that on the websites and things like that. COVID's not the whole front page anymore, is it, really? Like, as you said, there's other news that's sort of creeping in now, which gives an idea of their sentiment, doesn't it?
Yeah, it's probably even thinking living here in Melbourne, in terms of, I remember probably 6 months ago, I was looking at the news every day to check what the numbers were, all those sort of things were happening. Whereas I think nowadays, you kind of you're happy to read something else. You're not worried about what the total number was in Australia, or who's got a border lockdown or anything like that. You can kind of get back on with life and think more about that. Whereas I think we're probably a bit blessed here in Australia. I think overseas it's probably still more of a focal point. But once that as that continues to become more of a backseat driver, I think you'll see that, we'll sort of go back to that normal market movement and responses to everything.
Any other questions for Bryce while we've got him?
Bryce, a quick question from me. I see, like, your Vanguard's perspective on inflation. Like, there is some commentary out there that, with the numbers and that inflation has sort of kicked back up a little bit with bond markets and that sort of thing. Like what risks are there? I suppose Vanguard has their opinion, but what risks are there to the upside that interest rates might go up, which will then probably see some volatility with the share markets?
Yeah, so in the short term, and that's what we've sort of touched on, there could be a bit of reflation, which we're already seeing. And I guess the whole point of it is, I guess, to hold for the long term. So we're not expecting, as you said, there might be some short term spikes that come about from that. And we've sort of seen it through some bond markets. As now we're seeing sort of long term interest rates go up a little bit, which will have had some impact on bond investments on their capital side. But from a market point of view as well, we're seeing that more people, I guess, are trying to go to the market for better returns. So that's sort of also putting a bit of pressure on markets to rise as well. But a lot of the impact will be quite short in nature. I sort of touched on a few things in the presentation. So with COVID still at play and sort of employment still where it is, we just can't see that high inflation can be sustainable for a long period. But it may just sort of play its toll on the market in the short term with some volatility, which we've already sort of seen in the last couple of weeks.
Yep. Yeah, very good. And also just one last one from me. Like geopolitical risks and that sort of thing, like US, China's still there, like China, Taiwan, like is there any concerns around that from Vanguard's perspective?
Yeah, so we don't see that going away anytime soon. We see China still pressing and they want to be the powerhouse compared to the US, and sort of touched on it a bit more locally for us here, where we will still have our own tension with them. We don't see it sort of going too gangbuster here, as sort of we should touch on, there's sort of too much mutual destruction that I don't see that they want to do. But with the US, we think it's just going to continue going forward. It's not going to be drastic where you're going to see sort of giant market movements as a result, but you might see, I guess, that increased sort of tariffs through specific sectors one at a time. It's not going to sort of, I guess, ripple through everything.
Very good. Are there any other questions from anyone else on the Zoom? I haven't seen any come through the chat, so we might wrap it up there. Look, Bryce, once again, thank you very much. Really appreciate you giving up your time to give us a great overview. I really like how you can keep it nice and succinct and really make it quite straightforward to understand. I hope everyone feels the same way. So we will send a copy of the slides out after this presentation with a link to the Zoom meeting as well. And we will also be putting this audio into our new podcast, which is called 125 Years and Counting, so that you can get that on Apple Podcasts or on Spotify. So it's just a different way to listen to the updates as well. So
Perfect. Well, thanks for having me, and yeah, hopefully see you in a couple months' time again for another update.
Sounds good. Thanks, Bryce.
Thanks, everyone.
All right, thanks, mate.
I was going to do that superannuation update, Pete, but given my computer and that, I'm probably going to pass it off to next time, I think. I'm just not confident with it.
No, that's all right. Thank you, Mark.
Thanks, Mark. Going to stop recording, Pete. Are you still there, Debbie?
You're the host, mate.